So the problem is that someone has an asset and someone else wants to use it. The person who has the asset is the lessor, and the person who wants to use it is the lessee. And under this contract, under this lease contract, the lessee will actually get the right to use that asset from the lessor for a consideration. And that consideration might be annual, monthly, it might be periodic payments, it could be any kind of consideration. So the technical definition of lease is exactly that. Lease is a contract or part of a contract that conveys the right to use an asset, which is called the underlying asset, for a period of time in exchange for consideration. And this right of use is actually acquired for a specified period of time, and that specified period is called the lease term. And all the accounting would be determined by when the lease starts, how long the term is, and when the lease stops. And that is how we determine what kind of account treatment will also have to be applied to that transaction. First of all, let's think of a contract that has been signed at year 0. Now the contract has been signed at year 0 between two parties, A and B, and the contract is that B would give an asset for use to A for, say, 5 years. Now the lessee would receive that asset for 5 years, but it would not receive it now. It would receive it at year 1. Although the contract is being signed at year 0, the asset would be available for use to the lessee at year 1. And from there onwards, it would be able to use it for 5 years. Which means he would be able to use it till year 6. So in this case, the lease term would be 5 years. And basically, this is important because the lessor will not have the right to choose how to use that asset, or the lessor will not be able to take the asset back until the end of the lease term, which means effectively it is in control of the lessee till the end of the lease term. However, if, for example, the lessee had the right to terminate the lease at year 4, which is 3 years from the start of the lease, if the lessee had the right to terminate that lease earlier than the lease term, in that case, if that lessee is reasonably expected to terminate that lease at that time, in that case it would be considered that the lease term is actually year 3, because the lessee is expected to terminate it at year 3. Similarly, if that contract gave the lessee an option to extend the lease to 1 extra year, which means if the lessee had an option to extend the lease to year 7, and if the lessee is reasonably expected to exercise that option to extend that lease to that period, in that case we would say that the lease term is actually 7 years. So it's very important to understand here that the ball is really in the court of the lessee. If the lessee is expected to make a particular choice, then that choice would be the lease term. And all those choices would be determined in the contract at the date of the contract. And all of these options would be predetermined in the contract at the date of the contract. So we talked about a lot of dates here. Let's talk about the technical definition of what lease term really is. The standard says that the lease term is a non-cancelable period for which a lessee has the right to use an underlying asset, which means it's a period for which the lessee has the right to use that asset, together with both periods covered by an option to extend the lease if the lessee is reasonably certain to exercise that option. Which means, just as we discussed, if the lessee is expected to extend the lease, in that case, that extended period is actually the lease term. And periods covered by an option to terminate the lease if the lessee is reasonably certain not to exercise the option. We talked about 2 starting dates. One was where the contract was signed, it was year 0, and the other date was when the asset was actually available for use to the lessee. So the date at which the contract was signed is called the inception of the lease, and this is basically the date when we decide what kind of lease it is and what kind of accounting do we have to apply on that arrangement. And commencement of the lease is when we actually start accounting for the transaction, and commencement is where we start counting the lease term. So when an asset is actually available for use, only then the lease commences. So let's get into the core of the problem, what we are dealing with, what are the possible accounting treatment that we can actually opt for, and what the standard guides us into. So think of an asset for which which has a useful life of 3 years, and the lease term is also 3 years, and the lessor has given the right to use that asset to the lessee for the entire useful life, which is 3 years. One way of looking into that transaction would be that this is a simple rental transaction, and if we want to account it from the lessee point of view, and let's say that the periodic payments for that asset are $100 each year at the end of each year. So one way would be to look at that transaction as a simple rental transaction, and every year when the lessee pays that rent, that will be recorded as an expense in the books of the lessee and as an income in the books of the lessor, if it was treated as a rental transaction. At the end of the year one, the lessee would make an entry that it would debit its expense, rental expense, and credit its payable or bank. And the entry at the lessor would be the lessor would credit its rental income and debit its bank or receivable, right? But there's another way of looking at that transaction, and that is because the lessee has the right to use that asset for its entire life, it could be seen as somewhat like the lessee might have purchased that asset. In substance, the lessee has acquired all the significant risks and rewards of that asset. So we can actually look at that transaction as the lessee having purchased that asset on loan and make the payment in installments. So for example, the price of that asset was $195. It could be seen as lessee having purchased that asset on credit, and when we purchase on credit, the entry would be the asset would be debited in the lessee's book, and the payable or liability would be credited in his book, which means debit the asset by the price and credit the liability. Now once the liability is repaid, it's repaid with interest. So for example, if the price of that asset was $195, at the end of each year the lessee paid back $100, which means some component of the transaction was perhaps interest and some component was principal. And in each of those subsequent years, the entry for payment would include bank would be carried by $100. The liability would be debited by some amount, and by the remaining amount the interest expense would be debited, because when we are paying back a loan, the installment comprises of two parts. One is the principal, the other is the interest. So if this very transaction is seen as taking of a loan and purchasing of an asset, in that case the subsequent payment would be seen as repayment of that loan and interest expense. And also, because lessee is assumed to have purchased that asset, the lessee in this case would also record depreciation expense. The same transaction took place. One way of looking at it was to simply account for it as rental expense. The other way, which is a far more complex way to account for it, is looking at it as a purchase transaction on credit and repayment of that credit with interest, and then also accounting for the depreciation which the lessee might have to pay. Similarly, from the lessor's point of view, it could also be seen as a rental income, and if it is not a rental income, in that case lessor could be thought of as having sold that asset to the lessee, and the cost of that asset is credited because that asset is now derecognized in the books of the lessor, and what is debited is really receivable. So receivable is debited. Now each year the payment comes, some amount is credited into the receivables to reduce the receivable amount, and the remaining amount is the lessor's interest income. If the lessor was thought of having given it at rent, in that case the lessor would have to also account for depreciation of that asset. But if it is thought of as a sales transaction, in that case lessor will not account for depreciation. So these are two ways of looking at the same transaction. The only difference is, what do you believe is the substance of that transaction? If the substance of the transaction is simple rental agreement, in that case we will simply account for it as a rent expense or income. If the substance of the transaction is rather different, it's like truly selling an asset in substance, not really on paper but in substance, really giving the entire risk and reward of one asset to other party, in that case it would have to be accounted for as a sale and then repayment accordingly. And this is what the standard tries to tell us all throughout the plays. The standard tries to guide us on when to assume that the asset is being sold in substance and when to assume the asset is being treated as on rent.